Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So throughout this quarantine period, I've found me sort of spending my weekends doing much more reading than usual. And I recently finished getting through this book by Christopher Mayer, 100 Baggers, Stocks That Return 100 to 1 and How to Find Them. And someone in the comments recommended this book to me. I apologize because I can't remember exactly who it was, but someone did recommend this to me, saying it would be right down my alley, and it certainly was. And I want to dive into some of the main points that the author looks for in terms of finding stocks that will multiply dramatically throughout the period of time that you hold them. So this was very much a modern Warren Buffett style book. You're looking to identify companies with a lot of potential to grow, but you're not paying ridiculous prices for them, and you're holding them for often decades in order to get to this sort of 100 bagger status. So I want to go through the main points, and the way that I'm going to do that is actually by jumping straight to the last chapter because it has a summary of the whole book in that chapter. So if you're not wanting to have a bunch of spoilers, which I suppose you can still have spoilers from non-fiction books, feel free to click off this video, but I want to dive into it nonetheless. So the first caveat to this entire book is that statistically the study is somewhat kind of flawed, and the author admits this right from the start. If we're looking purely at 100 bagger stocks, companies that have performed extremely well, and we're not also looking at the other side of the coin and companies that didn't reach that status, it's a little bit like going out there and hunting for the genes that make people tall, but only using NBA players as your sample size. So it is somewhat flawed in that way, but I still found this extremely useful, and I want to go through some of the main points that can create 100 baggers for you in your investment career. Now, this entire book can be pulled right back to 8 core principles, so that's what we're going to go through here. And the first principle is a rather obvious one, but you have to look for them. You have to actually go out and do the work to look for companies that can potentially compound your money over a long period of time. And if you go into this exercise with the goal of only, thinking I only need to find 100 bagger in my life and I will be very wealthy, you're going to struggle to find those companies versus someone who wants to go out and find 10 or 1500 baggers through the career and is really turning over a lot of rocks and doing a lot of research to go ahead and find those companies. So you have to go ahead and actually look for them, as obvious as it sounds, and you have to really put in the work to go through a lot of companies, say no to a lot of businesses, and keep digging until you find one that ticks all these boxes. So that's the first step. The second step is growth, and more growth. So if you want to have a stock that multiplies 100-fold in price, there's no way to avoid the fact that you need a growing business. I am certainly someone who will invest in businesses that are not growing or that are growing quite slowly if they are heavily discounted to intrinsic value. But it's hard to beat a company that just continues to grow over time. You can still buy at a relatively cheap price, and then all you have to do is sit there and hold it over a long period of time. So you do need growth in some way. You want revenue growth or earnings growth, ideally a combination of both. And ideally that growth is high quality. So you're not in a business that is just growing revenue for the sake of growing revenue. They are growing revenue and actually maintaining or improving their margins, and a high percentage of that new revenue is flowing through to the bottom line. So that's the second thing. We've started off with a couple of obvious ones, but first you need to look for them, and secondly you need growth. So the third point is that lower multiples are preferred. So you can't go out and pay ridiculous prices for these businesses in order to get 100 baggers. If you do, it's certainly still possible to get 100 baggers, but it's a little bit like tying one hand behind your back when you're trying to search for these massive returns in stocks. So as an example, if you have a company that when you first buy it trades for 10 times earnings, and then 20 years later is trading for 20 times earnings, so that multiple has doubled. In order for that stock to be a 100 bagger, the company has to grow its earnings by a multiple of 50. So grows its earnings by a multiple of 50, you also double the PE ratio that people are willing to pay for that company, and you've got your 100-bagger. And that is often how a lot of these stories play out. They are companies that are not quite fully understood and don't have long track records. And when you first find them, people can be paying pretty modest multiples, but the reverse can happen as well. So if we take that same company that is trading, let's say this time at 40 times earnings when you first buy it, and then that multiple gets cut in half to 20 times earnings over the entire period that you own it, in order for that to be a 100-bagger, it's going to have to multiply its earnings by a factor of 200. So compare that to the company that only had to multiply its earnings by 50 to get to that status. It makes it much more difficult to get to this land of 100-baggers if you are paying those really high multiples up front. So certainly one to watch out for. You can buy really, really high quality businesses, and I've spoken about this a lot. You can buy really high quality businesses that will grow a lot over time and still have them be quite poor investments. And there's a sub point that comes in behind this one, which is combining points 2 and 3. So having that growth and having that multiple expansion, or the PE ratio, being pretty modest up front and growing over time, can sort of put the afterburners on what we're talking about here with multiplying your money in these individual companies. So point number 4 and criteria number 4 to find a company that has the potential to be a 100-bagger is it must have an economic moat. This is something that protects it from competition, number 1. But number 2, in terms of growing the business, is it allows you to get that good growth that I was talking about earlier. So you can grow the company and still keep healthy margins. So look at a company like Apple or like Chipotle Mexican Grill. They can both grow their businesses with relatively modest competition, and they've been able to maintain high returns on equity, high returns on invested capital, and keep really good margins, if not expanding margins over time. So that's what we look for. If we compare that company to something like a business in the auto industry, in the car industry, or in the grocery industry, there is not a lot of moat protection for many of those businesses. Some of them have brands, some of them are the low-cost producer, but there's a lot of competition that drives down the ability for those companies, first off, to grow, and second off, the ability for those companies to grow and still have good margins and not have to just fight tooth and nail to keep the business afloat with all the competition that's in that industry. Number 5, again, is a relatively obvious one, and this is that we prefer smaller companies when looking for 100-baggers. And this is simply the law of large numbers. So if we buy Apple today, as an example, Apple is trading for roughly $1 trillion. If we want that to be a 100-bagger, the market cap of Apple is going to have to go to $100 trillion. Now, that's not strictly correct. Apple can buy back a lot of stock. If they buy back 50% of their shares, then it only has to go from 1 trillion to 50 trillion in terms of you getting your 100-bagger, because you now own twice the percentage, and the share price should go up 100 times with the market cap only going up 50 times. So that's caveat to what I just said, but hopefully you get the point that for a company to go from, let's say, being worth $1 million to worth $100 million is much more plausible and happens much more frequently than a company going from $1 billion to $1 trillion, or $1 trillion in this case with Apple to $100 trillion. So we have to look for small companies. That doesn't mean we look for tiny companies. There are several examples in this book of businesses that were trading for right around $1 billion that turned into 100-baggers, and that's right about the cutoff where the author tends to draw the line in terms of companies that he's digging into for potential 100-baggers. Because right around that $1 billion market cap is typically where he's hunting, is below that number. Criteria number 6 for finding a 100-bagger is that owner-operators are massively preferred when you're going on this hunt. So if you have a business where the interests of the management are aligned as much as possible with the interest of the shareholder, great things can happen. It means that management is incentivized to grow the per share value of that stock. And a great example of this is someone like Warren Buffett. Now, Warren Buffett has over 99% of his personal net worth in his company, Berkshire Hathaway. So he is massively incentivized to do very shareholder friendly activities within the company Berkshire Hathaway. Compare that to a business where you have management with no shareholding or very little shareholding in the business, and their compensation package is purely based on short-term incentives like trying to get the stock price up and beat next quarter's earnings and largely forget what's happening over the long term. You can have some much more powerful things happen when you have owner-operators at the helm, people that truly understand what the business is all about, and people that have their incentives aligned directly with the shareholders in that company. So that's another really good thing to look for when you're searching for 100 baggers. Now, the final 2 points here, point 7 and point 8, are both around patience. So point 7 is something called using the coffee can approach. So you may have heard this expression before, but essentially it's all about buying the company, buying the shares in those business, sticking them in a coffee can once you've done your analysis. Largely, the hunt for 100 baggers, most of your work is done by buying well and then just sitting. So once you've bought those shares, stick them in a coffee can, metaphorically at least. We don't get physical shares anymore, unfortunately. But stick them in a coffee can and forget about them, basically, is what the author is saying. The average time for a company to get to 100 bagger status is anywhere from 15 to 30 years, typically, depending on how fast that company is compounding. So these are long-term investments, and it's going to take you a while to figure out whether you were right or wrong. And there's really no benefit to looking at the day-to-day of movements of the stock. Really, you want to be following the fundamental business and making sure that it's still on track for ticking all the other previous boxes. And that gets us into number 8, which is the final point that Christopher Mayer brings up on the hunt for 100 baggers, and that is to have a really good filter. Now, this is something that I feel like I have a very good filter in terms of keeping out the white noise and the short-termism in the stock market. And that's what you've got to have. So you've got to be able to ignore all the day-to-day news. Anytime the Federal Reserve changes interest rates, all this quantitative easing going on, all the stuff that, is quite important, but it's not something that's knowable. It's not something that we can look out 20 years and make predictions on how that might impact our companies or impact the economy. And we're much better off focusing our time on individual businesses and figuring out where we expect them to go. So even very major financial events can look like, mere blips on the radar for really high quality companies. If we take a business like Apple, which is an example used in this book, Apple went through the global financial crisis in 2008. If you had held shares in Apple since like the 80s, for example, and you were extremely wealthy by now, as you very well would be if you had shares since that point, if you talk to a shareholder that's held shares since that point, they're not going to go ahead and say, I would have been so much wealthier if 2008 never happened. That's irrelevant to what the business did. It's irrelevant to Apple developing the iPhone and the iPad and continuing to grow into offering Apple services and all these different things. And, largely we've got to think in the same way. We've got to focus on individual companies. Take Warren Buffett's example, Warren Buffett's investment in Coca-Cola as an example. That was a relatively quick 10-bagger for him. He's had another double since then, and he's had dividend payments pay that investment off multiple times over. So he's more than received his money back. He's received his money back several times just from dividend payments, and it's yielding something like 60% a year in dividends on his original purchase price. Now, if you go and talk to Warren Buffett about that Coke investment, he's got one of the best filters on the planet on him, that guy. If you go and talk to him about his Coke investment and you say, what went well, what went poorly, the last thing he's going to say is, I really wish that the dot-com bubble didn't happen because I would have done so much better in this Coke investment. What really drives your returns as an investor in individual companies over time is the performance of the individual companies. And if you've got a company with a strong moat, high return on invested capital, all these things we've just spoken about, then over the very long term, these large economic events that are happening on a macro scale are going to have basically no impact on what the business does over the course of 20 or 30 years. So got to have a good filter on you. Very, very useful, very, very important. And that is my summary of the main takeaways I got from this book of 100 Baggers. So if you're interested, I'll leave a link in the description. It probably will be an affiliate link, so I will get a kickback if you purchase that, but it doesn't change the price or anything for you. So if you're interested in that, click the link down below. Really enjoyed the book. Thank you to whoever it was that recommended this. Please make yourself known in the comments. That would be great. That's all from me today, though, so I hope you enjoyed the video. Hit like, hit subscribe. You can hit subscribe over there. Watch some older videos over there, and I will see you in the next one. Cheers.